In this video we want to show how to construct a cash flow statement. It's a very straightforward exercise, but it's one which is very important when discussing the financial processes within the business. The ability of the business, for example, to meet its current obligations and to have sufficient funds available from the sale of goods and to meet contingencies as and when they arise. So it's important to have a clear idea of how to construct a cash flow statement. It's a very important but yet simple financial document. Let's take this is just a very simple way of looking at it. Now let's say we have a cash flow statement over a 12-month period, and we're dealing here with product A. So for some company, they make a product which is called A, and they sell this product on the market for £5. Very simple, straightforward. And for each of the 12 months, we have the number of product A that's sold. So in month 1, they sold 20. I'll just put the cursor onto the screen to illustrate. So they sell 20 in the first month, 25, 30, and 35 in the fourth month, and so on. So we have the price of 5, and we have that. Therefore, the revenue from sales is simply 5 times 20, which is 100, 5 times 25, which is 125, 5 times 30, which is 150. So straightforward. So we can work out what the monthly revenue is. And in addition to that, we'll say that this particular company receives interest on money it's deposited with the bank. So in the second month, it receives 3, whatever 3 is, 300, 3,000, whatever. So it receives 3, and in month 8 it receives 5, in month 11 it receives 1, just to show how that is built in. So then we have the total receipts, of course, which is just this one, which is the sum of those two, and this one is 128, 125 plus 3, and over here 275 plus 5, which is 280, and the rest, of course, have nothing added. Now, let's say the business has outgoings, as most businesses do. And in this case, it has raw materials, labour, it's got overheads, bank charges, salaries, presumably different to labour, miscellaneous expenses, telephone and office, and capital expenditure. This is just a set of titles just to illustrate how the cash flow statement is constructed. If we were doing a real one, we'd have real headings and be very careful about the types of headings, ensuring there's no overlap between them, and making sure that they do refer to actual parts of the business. But in our simple illustration here, we just have these various headings. So raw materials is 13 in month 1, 5 in month 2, 5 in month 3, so and so on, just 5 all the way across by the look of it. Labour is this column here, or sorry, this row here, I should say, and overheads this row here, and bank charges, and so on. So we've just got different figures which we've added in here, and if we add up those figures, 17 plus 11 plus 12 plus 3 and so on, we get 97. And the next one we'd add up 157, and the next one's 151, and so on. So these are our outgoings per month within this particular business. Now if we take our outgoings away from what we receive 100, we pay out 97, so we're left with 3. And there's no opening balance on this account, so I've just highlighted it here as 0. We start at month 1. There's nothing before month 1. The business starts on month 1, let's say. So there's no opening balance. So we have, on the month, we have plus 3. So we'll add plus 3 to the opening balance, giving us a closing balance of 3. Now for the second month, the receipts are 128 and the outgoings are 157. Therefore, the movement is minus 29. It's 128 minus 157, which is minus 29. But we had 3 left over from the previous month, so that's our opening balance, 3. So over the month, we're down minus 26. 29 was caused by the month, but we carried forward plus 3, so giving us 26. For month 3, our receipts are 150. Our outgoings are 151. When we add all of this column up here, we get 151. So 150 minus 151 is minus 1. We've had 26 carried forward from the previous month into month 3. So minus 26. So minus 26 minus 1 added together, we have minus 27. So let's just look at what we've got here. We have 100, which is our opening. We had expenditure of 97, movement of 3, we had no opening, and we had 3 left over. That 3 we carried up as an opening balance into the next month. We add that to our balance for the month, which is 128 there, that's what we received, less our outgoings, 157, which puts us 29 down on the month, but we had the 3 carried forward, leaving us 26. And we do that all the way across to generate this row of figures here, which is our opening balance figures. You can see that this figure is the same as this one. So our closing figure on the month is our opening figure for the following month. Closing figure minus 26. In the following month, the opening figure is minus 26. Minus 27, minus 27, 0, 0, and so on. So what we've got then is the cash flow statement. We've worked out what the cash flow statement for this business will look like. So what the figure tells us is how successful the business is at handling its expenditure and trying to ensure that it's got sufficient resources to keep itself in business. If we look at the closing balances here, it's 3, minus 26, minus 27, 0, minus 5. It's gone through a bad period. This is a bad period for the business. Then, fortunately, 24, 73, 150, 230, and so on. So we have a good period coming up, which leads to these very positive figures over here. So the 203 we carry up as the opening figure in month 10. The closing figure in month 10 is 280, which is the opening figure in month 11. And that's the way it works. I've just colored them in to show where how they relate. So you can see straight away by color coding, minus 26, minus 26, minus 27, 27, 0, 0, minus 5, minus 5, 24, 24, and so on. And that is a cash flow statement. That's how it's worked out. That's one particular style. Sometimes people do it differently, and they take the opening balance and put the opening balance up here at the start, because this is where the the month starts from. They think it's up here, and there's no problem with that. If we just look at that type of style, there you go. I've just moved the opening balance from the bottom up to the top here. There's the opening balance, and you can see it's 3 and 3 and 26 and 26, and it comes down, and what we've got is the closing balance along here. And the closing balance is really what the business person will be interested in, to see if they've got sufficient reserves in the bank or available to them to pay their bills or to pay for any contingencies that may arise. And as I said, that's all there is to know really about a cash flow forecast and cash flow statement. Cash flow forecasts are widely used as one of the accounts, projected or forecasted accounts, that are used when setting up a business. Banks and investors like to see estimates of what the cash flow will be over, say, the coming 12 months. They'd like to see the projected profit and loss account, and perhaps some sort of estimate of trading profit and loss and balance sheet. So the investors would like to see some sort of estimates, realistic estimates of how the business is expected to perform over the coming, say, 12 months. And one of those will be cash flow. Of course, as to where the figures can come from to fill out such a document is very difficult to see, because we can't see the future. So being asked to estimate one into the future, it's very difficult. We don't know what the world's going to be like in 12 months' time. However, it's a document that is requested, and as far as we're concerned, we should know how to complete the document and how to fill it out, and what a cash flow statement is. And that's all this little video is attempting to do. So that's all we're going to look at. So thank you for watching.